financial system. Okay, it's a very big system. So many things in here. We also just, each section just cover a couple of things. Like I mentioned, even you talk about stock market, it will be big semester supposed to cover, but we cannot, okay? So same thing. So we just touch certain things and then we go deeper a little bit, then we go to next one, okay? Here it is. So financial markets, right? So first of all, we say, okay, financial systems, huge, okay, have everything inside, how they working around, how they moving money from a, one sector to another sector, one person to another person, how that works. Okay, so that's what we're gonna figure out. So in the system, we have a financial markets. You have bond market, stock market, you have all kind of financial instrument, the trading around. So how that works, right? So now first thing is we're gonna understand fundamental. What's the function financial market doing, right? What they can do. So here's to tell you, very, very simple. It's just like you have some money, I have some money, okay? You want to put the extra money, or we call excess money, a lot of money, you want to put a saving, right? Put it somewhere to make some interest. So put it where? You cannot put it on the mattress. You had to put it in the banking, put it in some financial intermediaries, we call that, okay? So banks. So banks, you put money in there. Let's say you have put a $100 million there. The banking keep your money there, but your money really, really already went out to invest, to lending somebody else, because somebody else need the money. But banking is reliable, will give you money back when you need it, right? So you put the money there. So banking becoming intermediary, in the middleman, okay, middleman, put it together. So that's what the banking doing, financial system doing that. So they perform the essential function of, so that's a key function, channeling the funds from one person to another. So we call them, we all players in these markets. Somebody borrow money is a player, somebody saving money is a player, banking helping us to do that is player, okay? So that's what they channel funds from one group of people who, have a lot of money, transfer to some people who need money. I want to open a restaurant. I want to do business. I want to borrow student loans money to go to school. So make those people can borrow, can access those funds, okay? So key point is channeling funds from one group of people, see, who have saved surplus funds to those who have a shortage of funds, right? So the first thing is very simple. Just from people who have a lot of money to people who need money to do business, but it's not giving, okay? It's lending to them. Then the savers who can make interest, okay? And then borrowers paying some money for borrowing, and they make a market, they both sides happy, all right? So that's what the financial market is doing, all right? Can happen, the bigger picture, just from one group of people, some money lending to the other group of people, okay? So, but when we say this money transactions, you will have all kind of activities, okay? So you can go to the stock market, go to bond market, you can go to banking, all right? So either way. So banking, you deposited their money, and the money will lending out to the borrower. So your classmate borrow your money. Borrower didn't go to you, they go to bank. Borrow student loan, banking lending to them. As the banking lending to the money to you is coming from the other person's money, okay? So that's what the banking doing, operating this way. So that's the bigger picture, okay? So borrower, see? Now, when we talk about this, we can talk about the direct financing or indirect, okay? So let's say direct. Direct is just your classmate borrow money from you. So you don't even need a middleman, right? Middleman, of course, will cut something in the middle. So your friends borrow money from you, you just give $10 and as interest. So it means you're lending $100 and then you charge $10 interest, so 10%. And then just between you and him, your direct lending. But indirect, we'll talk about indirect. Indirect middleman is banking. You don't need it. You don't lend into your friend. You go to banking, you put it there, and banking lending out, and that's middle. Okay, so we'll do that. We'll do So one thing I said, borrow, that's direct borrow to each other. That's easy to see that. Then if you go to say lending money, for example, today also have another one. Today is a bumble, right? Well, what do we call that today? That IPO, Dumbo, right? Called Dumbo. So Bumble, whatever. Today have one IPO. Okay, so when they do IPO, you just directly invest the company. That's whoever doing the IPO. You just give them the capital. They raising capital from there. Then your money becoming invested in the company. That's also IPO that way. Is direct go to the market doing that. Give the company. That's another way. Okay. So I just mentioned about borrowing, lending to each other, where don't need anybody between. That direct lending. All the other one is just directly to invest on the company. That's direct. Okay. So now whole point talk about the funds. The funds are money. Okay. So money, how they channeling between each other in these markets. That's how markets are functioning. Okay. So because this one, imagine if we don't have banking there, you want to put money somewhere, actual money, okay? You don't want to put it on a mattress. Under the mattress, you could be worried about stolen, burning down, inflation, a lot of things. So now money market now efficient because the money useless, didn't do anything, right? If the money lending out to somebody and somebody make a lot of money and can pay you interest, and then this economy will do better. So you and me, we all well-being getting better, economy getting healthy because everybody working hard and to do business, use those money. So therefore, this function provide efficiency on the economy. Also provide well-being, right? Make you better. You see, you get a loan, you can go to school. Imagine you cannot borrow from anybody to get a loan. You're just waiting there, waiting for go to school. I cannot go to school. I don't have money. I have wait. So you waste your time. You waste your golden age years. Just sit down there waiting for go to college. Imagine that, right? So let's say you have brilliant idea. Want to run business. I don't have money. I want to run, French cuisine or Italian cuisine of the restaurant. I have an idea. I have skill, but I don't have money. I cannot do it. So that's what is not good. So therefore, we have financial markets help you to achieve what you want. So that's why market provide well-being. You can go to college. You can realize your dream to open restaurant, to do anything. Okay, so that's why it's better off have this financial markets to help you. All right, so that's the one thing is give you idea. So financial market. So now give you a big picture how that works. All right. So let me make it bigger so you can see the channel, how they channel. Okay. You can see those ones. So basically, it's everybody. Okay. Lender or saver. You have money, you can lend, right? So that's why you are saver. So when you have a lot of money, who can be? Can be anybody. Excuse me. So households, business owner, right? Business firm, government have money can lending. Foreigners have money can flow in here, lending to us. Okay, so means they put money deposit in our banking, and then we borrow from banking, and then we got it. All right. So whoever, that means global, anybody who have money, that's one piece here, all here is can be lending two channel. Okay, one is go to direct channel, the blue one. Okay, to go to the markets, like I just mentioned. The best example is just you invest. Remember, any company, which one you're familiar about IPO? I mentioned that initial public offering. So when you first they raising capital, do the IPO, you buying the shares. That moment, the company, whoever issued IPO, they get your money. Okay, So then they use immediately, let's say the day one is $1 billion they collected from the market. That means you and me, okay, we all buy their share. The $1 billion belong to that company. For example, Uber, okay, or you maybe Tesla, whatever you submitted the IPO. So the company have it, okay? So then they will bring those money back to the company, go to do their project, do their business, all right? So that's what direct financing is. If they are next day two, okay? So day two, once they do the IPO, day two, it's not any money trading, it's nothing go back to the Uber anymore. All right, that's the secondary markets. We'll talk about that, okay? That's you and me trading. It's not really the money go back to Uber, the IPO company, okay? So that's why day one is a financial market, they direct financing, all right? The best way also is lending. You're lending to each other, just know anybody else involved. That's can do that too, lending. So direct financing. But who is the other group of people? See, also another person. Just like I say, your classmate could be depositor, but the other classmate could be borrower. It's just an old classmate, right? Could be anybody. See, borrower, spender can be business borrow. They borrow money, do business. Government borrow, we borrow money, okay? And household, you can buy a mortgage, you can buy a student loan, remember? Foreigner, they can borrow in here too from our bank, so they can borrow. So means you can see the same thing, right? So can be anybody. You have a little bit of money put away, saving, your money will be lending to somebody else, okay? So somebody else just use the money, do something. So this is the direct way, and the other one, intermediary. So means inside can be banking, can be insurance, can be anybody in here financing. They use your money. You think you put money in the bank or in the broker account or whatever, but it's really not. They use your money securitized to lending somebody else or selling to somebody else. But they responsible for you, right? So that's, but they collapse your trouble. We will talk more detail. But now just all you need to know is the market, the money through this market can channel in two ways. One is directly, okay, financing or saving, transfer to the other party who need the money, all through the intermediary, which is the middleman, okay, intermediaries, financial intermediaries is middleman who is happy you, they find a both party, find out this deal for both party. Okay, somebody want to borrow, somebody want the lending. Okay, so everybody have better off. Somebody make money. Okay, somebody do business, make more money and pay back a little bit. So this is channel. Okay, to tell you how they channeling money in this system. Okay, so now how this market we can looking at. You see now this market is so big, okay? This is, like I said, financial market. It can have everything, have securities, have banking, have investment, have insurance, have bond, have stock, have CDs, have a lot. So how are we looking at it? So we group a little bit. So one group is this market can do this way from a securities point of view. Means security, remember bond security or debt security or equity. Equity is stock, right? So the market we can cut off as one piece is bond market called debt market and equity market, right? So bond market, this is bond market, this is the stock market. Equity is stock, remember I mentioned that? So that's stock market. So that's two pieces. Bond market and stock market called equity market, okay? So in the bond market here, debt, also called debt, okay? Bond is debt. Why bond is debt? Because the bond is borrowed. Let me say again. Let's say if Apple company, they wanted to borrow money, they issue bond security, right? So they're selling to you. You buy $1,000 the Apple bond. Basically, you're lending money $1,000 to the Apple, all right? To company Apple to them is debt. They owe you $1,000. So this debt, okay, that's why it's debt instrument. So this debt, the company issued the bonds selling to you, it's not debt, okay? So that's why you say it's done debt bond market is debt market, okay? Now, we just mentioned that if you buy the Apple, this bond, they definitely will tell you when you buy the moment they tell you what's the maturity. You buy $1,000. It's not like a stock. Stock don't have maturity, right? But the bond you have it. It could be they tell you up front before you buy. You already know. Say okay, you're lending $1,000 to the Apple company. You can say I'm lending 1 year, a 5 year, 10 year. And so what's the deal they give to you? And then you feel so happy, you like it. And then you're just lending this 1,000. That's that they promise paying you 5% a year. So that means you lend 1,000, you also get $50 a year, every year, all 10 years. And then you get $1,000 back too, your principal. That's your money. So that's what you're lending money for, right? So you get your money back. Also, you get $50 a year every year. Where we get $50? Because the 5% of coupon they promised to you. We will talk about more about this, just to give you an idea about this debt instrument, the bonds. If you buy, they have maturity. They maybe have coupon. Why is that maybe? Because some bonds do not pay you coupon. Okay, when we touch that level, we're going to talk about this. But so far, just let you know, you have bond market and they have a stock market. Okay, so that's the stock market is equity. Okay, so equity here, so equity also, like I mentioned, is a stock, right? So stock, you will see, somebody knows, some stock, they paying you dividend, okay? Some company do not pay you dividend, okay? So I want to ask you, anybody know why company do not paying you dividends and you still wanted to buy the stock? What's
Growth.
the incentive? Very good. Yes. Is a company, if growing, let's say new startup company, new company, they so young company, they don't even mature yet. So then they just wanted to grow. So everything they earning, normally they earning, okay. Remember you're working hard, you earn money, okay. Same thing for corporation. They working hard, they make money, after pay tax, then that's becoming their profit, also called earning, okay. Profit is equivalent to earning, same thing. But they normally doing calculate the earning per share because so much shares outstanding, like Apple, right? A lot of outstanding shares, and they earning maybe billion dollars divided by outstanding shares, that becoming earning per share. So maybe $5, for example. So this is $5, then they cut. They will say, okay, we want to pay the dividend to our shareholders, make them happy because we have a lot of money. We don't need growing. Even growing, we don't need that much because the Apple's $1 trillion corporation. They have a lot of cash, okay? So they say, okay, I'll pay dividend. So they can say, let's say 2% or 20% of earning pay dividend per share. And they will do that. So you will see those statements that will tell you what's dividend, ratio. All right. So some company don't, like Tesla, Google, they don't pay dividend, and a lot of people buy those stock because they are growing company, still growing. They still have a lot of opportunity to grow, so they don't have money mature yet to pay dividend, so they don't pay. But people buy because they are growing fast. You buy at this price, but the 5 years later going to be higher, and then they feel, I don't care about dividend. I care about growth. Okay, so that's why it's growth. That's true. Very good. It's growth stock. They don't pay dividend. And if mature, the value stock, they pay dividend. But you also have some company in the middle ground, nothing clear cut, right? So you have middle ground, some companies semi-growth, semi-dividend. So that's also have that kind of called growth dividend company. Okay, so different. When you invest stock, you will know. But at least you know now that instrument and equity now. Okay, so that's one cut of the markets. Okay, it's just one angle how to see it. Now we have another angle, okay? Another angle is we cut a market from the other way. Which the other way is, one is primary markets and one is secondary market. So same thing again, cut another piece. So what do you mean? Okay, so remember this is a market we talk about, so financial market, right? So every new security, remember everything had come out of the market have to be from day one, have to be new one, right? First day's new one. First time we have this stock, that's a Tesla. We never have Tesla, but first they come out of Tesla that day, come out, that's called primary market selling there. So when the IPO, initial public offering, those IPOs, all they selling at the primary markets. Okay, so primary means the first time, right? That's called primary. You know, the movie first time I issued, they call primary day of the movie. So this is primary, first time selling. So IPO is there. And any bond, any other security, first time selling, they all in the primary market, day one, okay? But second day later, this means after one day, then becoming trading, becoming you selling, I buying, somebody else selling and buying. So we're trading to each other. That's all those security we're trading is second hands security. You know, second hand meaning, right? They use it like use the car, second hand car, right? Same thing, the stock or bond, second hand. You trading, me trading, that's second hands. That's why I call secondary, because not in the first time selling, not first time IPO. It is second, means already trading it. So therefore, right now you buy Tesla stock or buy the, you know, Apple stock, they all secondary markets stocks, because the trading already went to the IPO. Okay, so that's how we know now. So you have, from market point of view, you can see primary market how they selling it, the first one, and secondary market how we trading. So now you know, if in a secondary market, let's say you buy the Google stock, okay, you buy yesterday, but the Google, you know, IPO years ago, okay, so you make $10 of the trading. So somebody else selling, no matter what we're trading, selling, Google don't have this money involved at all, okay? It's just you and the other person in the market, so secondary market, okay? So that's nothing regarding Google that much. Google raising capital from primary or new security issuing or bond issuing, okay? So let's go back and see how they do that, how this IPO works, how they went to IPO, right? So first thing is when Tesla go to IPO, how they do that? Let me ask you actually. How does Tesla go to IPO? Right. Okay, very good. So they have to find this financial intermediaries, investment banking, okay? So that's what normally they do, okay? They go to investment banking, find out Morgan Stanley or Goldman Sachs. They say, okay, I want to go to IPO. I want your help. And they are professional. They're doing that, okay? They have IPO desk. They do research, they do cover everything about this, okay? Roadshow, go to the marketing, everything. I will talk about detail. So investment banking, let's say Goldman Sachs get this project to do the IPO for you. So that's Goldman Sachs becoming underwriter, okay? So that's what they choose. So Goldman Sachs will do research about your pricing, how many shares you can sell, total how many capital you can sell. That means raise capital. For example, Goldman Sachs say, okay, you can pretty much based on the market appetite, based on the money, a lot of free money in the market, you can sell in 1 billion, okay? Then we estimate your industry or this sector, whatever, they say, okay, you can sell in $20 per share. Okay, so then you calculate the $1 billion you can raising and divide by $20 per share. You know how many shares you can selling in the market. And that's what they help you. And they also doing roadshow, mean the roadshow, mean on the road to showing to those nationwide of potential buyer. For example, money manager, hedge funds, mutual funds, all those money managers, they have a lot of money and they want to invest on new IPO. They buy in the beginning, so that means they can get a favor, right? So whatever. So then that's what it means, roadshow, meaning they on the road, go to Tennessee, go to New York, go to the, DC, to go all the money manager, tell them that we have this IPO. Do you want to buy? We want to sell this share, and this is what their business model, and they feel good. They buy. So then they say, I want a 100 million. The other one have 500 million. So they book it. And they say, okay, total, I can sell it 1 billion. Great, that's it. That's what they do. Okay, so underwriter do those jobs. So then at the IPO that day, and then they just like today, the open market waiting for 1 hour, they tell you open, boom, that moment you and me can buy. Okay, but between that, those money manager already buy a lot of share. Okay, and then market trading IPO as well. So at opening market, and that's what becoming private market first time selling IPOs. Okay, those underwriter. Just hedge on a little bit. Okay, so underwriter when they selling helping this company IPOs, sometimes so big like a Facebook at that moment when they do IPO, one bank cannot do enough. Okay, so means let's say Goldman Sachs help. But a couple of billions, they cannot do it. So they have to ask other bank, like Morgan Stanley, like Citigroup, or other bank, help them join the group. Like let's join together underwriter. So then Goldman Sachs become a leader underwriter and others member. But then they sharing this profit. Okay, what do you mean profit? Because it's a fee, service fee. Okay. So then normally the investment banking will say, okay, Tesla, if I doing IPO for you, my service fee was 7%. So that means whatever I raising capital for you, let's say day one we're raising 1 billion, 7%, 1 billion is my profit because I service you. So that's how they make money. So that's why investment banking, even they do a lot of IPOs, they make a lot of money. So you will see if this season of IPOs, investment banking stock will going up because they know they're going to make money from there. Okay, so that's what it is on the primary market, and it's have the investment banking help them to underwrite those securities, for example, stocks. Okay, so that's what I mean. Now we say it's a secondary market. Remember we said once they do IPO, people bought the share in the first day one. Okay. If you don't have a secondary market, let's say you have day one you buy Tesla, okay, and then you make it's not you make money because you haven't selling yet. You're only selling, you know you make money now, but you buy it. But then you say, you know what? I regret it because maybe not good. Remember a Tesla CEO himself even short selling started. He said it's too high. So then if you regret you want to selling without the secondary market, you cannot sell. So you change your mind, you want to sell it, nobody buy yours because no secondary market. So we have to have a secondary market, make people free to choose to buy and sell. So then let's say you change your mind, now we have secondary market. So second day you say, you know, I make 20% day one. I'm happy enough, I'm out. So you're selling. So you're selling that moment at the secondary market. And the other person, for example, me, okay, and then buy the share because I like it and I buy it. And then you selling to me, so you make a profit, and then you will be lucky. I buy it at an expensive way, but then I buy in the future, right? I say future, if I'm holding 10 years, and then imagine that moment they say, if you buy the Amazon at $8, right now you're super rich, right? So you're holding forever, who knows, right? So that's the secondary market, okay? Now, if you can buy, say you selling share, buy Tesla is selling to me. You do not know me. I do not know you. You didn't looking for me selling to me. Yes, you didn't. You go to broker, okay? And that's what we call broker dealer. Okay, let me mention again. Let me ask you first. Do you know who is the broker dealer? You know? Anything?
Broker is basically a middleman that connects buyers and sellers in the
yeah. Give me in our market who is
Robinhood, TD Ameritrade, Fidelity.
Very good. Good. You first mentioned Robinhood. So Robinhood is the all your generation play that one. Okay, good. Robinhood, TD Trade, Fidelity, Vanguard, each will merge. They all merged. Okay. So yes, a lot of broker. Okay. So we just mentioned about Tesla. When you want to trade, you cannot just trade. You have to have account first. You have to have broker account. Okay, so get the broker account, then you're starting to trade. Okay, then I know now you have Robinhood, don't need it, don't require that many things, but traditional one, you need to have margin, you need the things. Okay, but if you buy, you don't need to pay you don't need to put a margin. Okay, but you're short, you need a margin. We'll talk about those. Okay, for right now we just talk about broker dealer. Okay, very good. So you need an account, you need a broker. So that's what broker becoming secondary intermediaries, okay? Financial markets intermediaries, because they are in the middle and to help you. So broker dealer, normally they do the same job, but a little bit of difference, okay? So broker dealer, broker, if you buy a house, you all call them broker, okay? So broker is match, they, remember I said TD Trade, E-Trade, or Fidelity, they are broker account. And then they find out who's the buyer, who's the seller, right? So you immediately have people just say, right now, everything online is easy. They can see who is, they have people selling. So that's a broker trying to match. He said, okay, you want to selling 100 shares the Tesla, then they will see who will buy 100 share, Tesla. Then waiting. Okay, we find somebody, and then we linked. Okay, so that's the broker doing a match the trade, and they just make the commission fee. Okay, you pay $2 per trade, maybe like that, and multiply the volume, so whatever. So that's what they normally do. That's a broker matching. Very good. Okay, you did a good answer, matching. So dealers different. Dealer normally is they have some money, they trading with you. Okay, you want to buy the Tesla 100 shares, they selling to you right away. Okay, and then they turning around, they are going to buy 100 shares of the Tesla, trading with another person. So they trading with either directions. They happen you very quickly. So that means now don't need a matching, sit down there waiting. Now they're trading with both sides with you. And so that's how dealer working is trading with you, use their money, but make very quickly trading, because they immediately use their own actions to fill your trading activity. So that's what they do. But normally broker dealer is within the same broker house or intermediaries, institutions. So that's why normally you cannot distinguish that big difference, because they are same thing. They do trading with you, match with you, do everything same. But that's what they do. Okay, they doing is on secondary market. So when you trading, you need a broker account. Well, once you open the account, they can buy stock, buy ETF, buy anything you want to, depending on the broker coverage. Okay, like you guys use Robinhood, it's just they don't even charge you anything basically. That's why right now they investigated to say who's wrong about the GameStop or short squeeze. Okay, so they're trying to find out. Okay, so what is the question is it possible for civilians to trade the stocks OTC with each other? You want to trading, what do you mean? We all right now, most of the market trading is OTC right now. Your NASDAQ is OTC, okay? So what do you mean trading with each other? Just like you want to trading with your classmate, you do not know your classmate. You cannot do that way. OTC, we all, like I said, NASDAQ, right now, everything almost is, what do you mean not OTC? How about that? OTC right now, we all trading is OTC, over the counter. Okay, we'll talk about that. Only things not OTC, it is go to New York Stock Exchange. Only New York Stock Exchange, see this little lady even mentioned about it, could be another version. But anyway, New York Stock Exchange, go there, you're looking at, that's how this stock trading original way. Means in the beginning, okay, in the years of one, the beginning, founding father of trading stock is there, New York Stock Exchange. You can see the yelling, shouting, whatever, that before the pandemic, you can see them, you can go there. But that's what they trading stock in their exchange. Normally is have the floor traders, special list. what did I mean? Okay, I'm just give a simple idea about what they look like. Okay, so they have booths. Okay, a table, bigger table like a booth, right? So inside this table, it is IBM. That table is Apple. The other table is Google. They only specialize on their own stock. So they're trading with all the people coming, only trading this desk is for the Google stock or Apple stock. That's stock exchange. They specialize on trading on that one. Buy, sell, buy, sell. And the other booths go to trading another stock. So that's the surrounding there. You can see the stock exchange trading that way. People are yelling, shouting, saying more share or selling, or look at it like a chaos, very chaos in that way. But that's a traditional way, okay? They're trading for the clients. So for example, rich man calling that broker said, hey, trading me $100 million. You saw the movie, they all like that, right? And then they will buy selling and they are maybe crash the market, they're trying to shorting. A lot of movie like that. So that's the stock exchange. That's only visible, okay? Can see what happened. But in the real world right now, that exchange is just symbolic, useless, okay, just symbolic. Just looking there, we have founding father that build up that way and showing exchanges there, but we don't need it anymore. So that's we all are electronic trading. We all, almost all the OTCs right now. So that's why, okay? So that's how you through your broker link to the NASDAQ exchange, New York Stock Exchange, and trading, that's it. That's what I mean, over the counter, okay? We talk about more about when we talk about that, almost there. And that's the broker dealer. So let's see another way, all right? So what's about, yeah, here you talk about OTC. So I mentioned already, right? See here, only thing is here I want to mention is the Chicago commodity, okay? Commodity is very, very important, okay? Commodity, imagine, let me ask you, see, Ashley, did you see when you go to a supermarket, you buy apple, milk, oranges? Did you see how good it is? The bigger, small, they all standard, right? They all big, and then small, that's apple. They all same size. So the small one have different price, small group one, and the larger one have a bigger price, and they all get out very well because that's trading from Chicago commodity market. Because commodity market is very good label. They say this A1, for example, is Apple have A1, A2, A3, for example. That means the best quality Apple was the price they're trading, and second quality, third quality. And that's how the market trading label the quality of the price. You think that's what the commodity market is trading. For example, you are a farmer, okay? You're a farmer, you know on August, your corn will mature. You will selling corn on August. But you cannot waiting for then to selling. By then, the corn market price can be anywhere. Can be, you know, very, very high because the nobody growing corn or market or the corn is a shortage, whatever, flood, whatever, price could be high. But for farmer, maybe happy, it's okay. But what if bad year? Even if by then, flood, whatever, corn is not good, but also price dropped. Nobody wanted it. Its quality is not good. So farmer, you cannot, endure those drop of price. So farmers say, better I just know what I'm going to selling. So now they get into the commodity market. They say, okay, in their future contract, okay, we'll talk more about this. And they will say, okay, I will be selling on August, selling how many my corns at, let's say, 50 cents per bushel, right? So whatever it is, the price they offer. And then they know the price already. So that's okay the whole year. If something wrong, it's okay. I still can sell in that price. So that's a commodity market. Okay, oil trading that, like I just said, oranges, apple, everything. Okay, future market. That's what they're trading, commodity futures. Okay, so that's a very, very popular market in there in Chicago there. Okay, so like I mentioned, New York Stock Exchange is just like a symbolic that way. Actually, we don't need it anymore, but still there. We want to keep it. But that's the stock exchange, physical they are trading. But most of them already go to OTCs. Okay, like I said, NASDAQ is OTC market. You do a lot of electronic on the broker. Basically, we all do the OTCs right now. Now they telling you foreign exchange market. The foreign exchange 24/7 opening, like we said, $4 trillion market. Many countries when we sleep, they are opening. So it is a OTC market, okay? And the federal funds, you know, this another thing is bond, all the bond, federal funds, bond market, okay? Okay, so they all trading OTC. Bond definitely is OTC. This OTC over the counter is coming from original from the bond market, because when we have a New York Stock Exchange, people trading stock like that way, the bond is just like what we're doing now on the computer monitor. Then the centralized about the price, you offer the price, you put it in, and the other person offered, and then they are questioning about which is the price the best, then somebody buys through there. So that's over the counter. So bond market always through the over the counter trading market, okay? So right now, almost everything, okay, almost there. So the money market, so from that angle, right? So now we go to, if the market have so many financial instruments, means so many securities to invest. If you're a money manager, you're confused, a lot of money, a lot of things you can invest. So which way you go to? Like your client say, okay, I want to put my money in the money market, not the capital markets. So you know what I mean? You have to ask, right? So, okay, that's what I mean. So make the market instrument, stock, bond, CDs, saving account, checking, everything, group it again. So make a short-term maturity security, less than 1 year. Those any security, as long as maturity less than 1 year, put it in the money markets. All right, we call those securities that belong to money markets. And the rest of that, longer than 1 year maturity, we say it is belong to capital markets. Anything longer than the 1 year maturity, okay? So that's easy. Why we do that? Because we organize a little bit of this market, because too many things, right? So then that's easy now. So if you have a 3 months T-bill, 3 months T-bill, T-bill means treasury issued, our government, the treasury, all right? So treasury department issued a security for 3 months maturity. So that's called 3 month T-bill, called bill, okay? If long-term, called bonds. So 3 months T-bill, if they selling in the market, so they belong to which market?
The money market?
Yes, exactly. Very good. So now let's say we have job market offering. We say, oh, we have one job is it is money market position. Now you know when they ask you a question, you say, okay, I understand the 3 months T-bill how that works. I understand the short-term CDs how that works. Bingo, they know what I mean. So that's what I mean the money market. Okay.
Professor,
so,
can I ask a question?
Yeah, go ahead.
So I see that. So where are short-term equity securities traded? Because long-term equities are in the capital. So where are short-term traded?
Very good. Equity is forever. Very good. Okay. Very good question. Let me challenge you. Equity is a stock, right? So stock.
Right.
When stock gonna mature?
It won't mature until I sell it.
They won't mature. Yes. Very good. Stock never mature unless the company collapse. So the company can be collapsed tomorrow, maybe forever, like a GE, like a GM, IBM. They like your grandpas of the stock. That means like that way. So if the stock doing well, they forever. So they forever means they belong to where?
Capital markets.
Yes, capital market. So okay, so that's a key point. Very good question though, because stock you can hold in short-term period. You can say today I buy. You can even buy in the morning, selling afternoon. They're day trader. That's what they do, right? Day trader doing. So you can flip stock, but still, no matter how long you're holding, doesn't matter. The stock is forever there unless they collapse, bankruptcy. Otherwise, it's there. They could have changed the name, but doesn't mean anything, right? So stock is belong to capital market, okay? So, but the stock, you don't have short-term, long-term. It's how long you're holding is depend on you. That's you hold short-term, but the security is belong to capital market. So now go to capital market, you can buy many things long-term one. So stock don't have a short-term, always long-term. Very good question, okay? Because that's the easy to distinguish them, okay? So that's the capital market. So long-term debt, like we know, any corporate bond, treasury bond, long-term than 1 year, they have 2-year bond, you have 10-year bond, you have 30 years. So corporate and also treasury, they all can issue. That's a long-term bond because they want to borrow longer time. All right. Okay. Very good question. Let me go next one. Okay. So we go to detail now. So we already talked about those, money markets, capital markets. So let's see detail instruments. What's inside in each market, right? So let's see here. So very important here is the first one is treasury bill. Like I mentioned, it's the U.S. government, our Treasury Department. Treasury Department, they writing the check. Just say, okay, give you how much money issue. And that's what they do. And so this is how they issuing, right? So they issue the Treasury bill. So that means short-term maturity government. So this tell you size at that year, okay? So this as 2000, which year? They didn't mention that. Okay, here, 18, okay? 1980 to 2010. So definitely don't have a 2021 yet, because if you see this another 10 years, that'd be big, okay? Right now it's very big. So you can see over the time, you can see the treasury bill already going all the way $1 trillion, okay? Why trillion? Because here in billion, the unit, each unit is 1 billion. So if 1,703 billion, that's 1.77 trillion, okay? So it's a lot of money now. Okay, so same thing. So treasury bill, you understand, is government, our government issues short-term debts, okay? Short-term debts called bill, okay? Long-term called bonds, right? Mid-term called notes, we'll talk about this. So negotiable bank certificate of deposits, this CDs, okay? The CDs, but however, it's not a small amount of CDs. Small amount of CDs, you go to bank, you just deposit money, you wanna buy CDs, you just deposit money, put a CD, log in 6 months, that's it, $5,000, that's it, and you earn some interest. But banking normally, they don't want the money sleep, so they issuing this kind of CD that you can trading in the market. So that means you and me trading means they can trading in secondary market. You and me can trading. So I can buy CDs, tomorrow I can sell in CDs. You will feel surprised. How come? Yes, certain level CDs you can trade. Go to your broker account, you can see it. They have CD they are selling for you. Okay, so you can trade in that. So that's negotiable CDs, okay? You can see that because that's the one way of banking funding. Banking get the money, get the funds to do business. Banking want to do business, they have to get the money to do business. So they have to do something, issuing CDs, okay? So you can see also over the years, you also 1.8 trillion, all right? So to 2010, right? So that's what we know. So commercial paper. Commercial paper is belong to money markets, okay? Because short term, how short? 270 days maximum. So what's a commercial paper? Commercial paper is corporation issuing debts, short-term debts. Okay, let me say it again. Our government issuing short-term debt is called treasury bill. But a corporation like Apple, if they borrow money, they issuing short-term one, less than 270 days of the borrowing, they will be issuing commercial paper. All right. You were wondering, is that, wait a minute, Apple so rich, Google so rich, why they issuing commercial paper? They have a lot of money, why they do? But that's a strategy, right? That's a strategy. You have a lot of money, you use the money to invest on long-term project. For example, Apple use money to build up, they wanted to do the car, electronic car business right now, right? So whatever, you have long-term project, you use the money. Short-term one, for example, I need a financing to get my payroll, right? Pay employee monthly. So I borrow, 270 days. I have a lot of money. I don't worry about interest. I can pay interest. That's what they do, right? They issue the short-term debt and then pay your interest. You buy that one, 270 days, you get your money back, you earn some interest, okay? But because it's a corporation issued, they also have default risk. Right? Whenever linked to the risk, we say is a corporation, always can be default. Anybody, we call the good company, let's say AAA company, can be default too. We call falling angel, okay? So still can default as long as your corporation, corporate security. But if our government security, so far we haven't default yet. So who knows? We are borrow too much money, okay? Like today I heard about that. So we are going to have 107% of GDP of our debts. Let me say it again. Our debts in the future, short future, next year, next couple of years, will be 107% of our GDP. What that mean? That means our borrowing money, just imagine your home, right? Your income is your GDP, and your debt is going to be 107% of your income. Means all the money you earn going to pay debt, even not enough, because you still have 7% more. And that's what we are going to be very soon, okay? Many years ago, not many years, just maybe a couple of years ago, I teach this course. That moment we talk about, we're so happy because that moment we talk about Italy deficit, they debt, it is 101% of GDP. We are laughing them. We say, wow, they are borrowing, the all GDP going to pay debt is not enough. That moment, U.S. is 70% of the GDP. So that means our debt to GDP is 70%. So that moment we're laughing out of the Italy, say, oh, look. So now what? We're going to be there very soon. So that means that's the whole point. You guys are learning this course, not just for fun. It's your generation, it's your burden. I don't know how you're going to figure out to overcome those debts. Eventually going to be a problem. And it's your burden. And a lot of retirees collect Social Security, whatever. So a lot of problem. So that's becoming issue eventually, because we spend too much money, print too much money. But we do not know. Only you had working hard, generate efficient productivity, increase the maybe can cover soon. I don't know. So that's another thing. But if we do not issue the money, then people will be suffering. Some people, don't have job, a lot of problem. So right now it's really trouble problem, but only stock market happy. But now today's stock market a little bit wake up, realize is too much, but it's still too much money floating right now, okay? You can see this is the 10 years short, right? The 2010, you can see over the time, everything is bigger, okay? So everything money increasing. Okay, continue next one. So that's just to say, okay, commercial paper we understand now. Okay, so next one, the Fed fund rate. Okay, Fed funds, our government, the Federal Reserve Banking issue the money. That's what the interest rate controlled money supply. That's called Fed fund rate. That's interest charged, and then that's money called Fed funds. Okay, Federal Reserve issue the money. Okay, well, then the other one is repurchase agreement. This is actually a good story, okay? This is called repo, okay? Repurchase agreement. Just a couple of weeks ago, our government mentioned that overnight repo eliminated. Means we don't do this anymore, overnight repo. But still they have like a weekly repo and semi-weekly repo. Okay, so what's repo? What's a repurchase agreement? Okay, obviously it's an agreement. You and me agree. But it is repurchase, means I agreed to buy back. Buy back, that's a repurchase, right? So I'm selling to you and I agreed to buy back. That's what I mean. Okay, very good. So how that works, and very important, okay? I'm going to give you the story, then I will give you that's how the mechanic works. The story is repo market is a huge market, okay? Financial crisis 2008, we didn't run on the bank. So what that means, didn't run the bank? Because in 1929, financial, we call Great Depression. That's the worst one in the history. That moment, we did run on the bank because people online just day and night waiting to withdraw their money, the cash. If you don't withdraw, will be gone. The bank collapse, so your money will be gone forever, right? You will be devastated. So that's the problem. So this time we have financial crisis, 2008. we didn't run on the bank. But actually, in fact, we run on repo. This repo, okay, this repurchase agreement, we also give a short name called repo. We really run repo. You said I didn't. Yes, you didn't. I didn't. But our banking run on repo. Banking collapsed just because this repo problem, okay? So let me talk about this mechanic, how that works, right? Just assuming you as a money manager, for example, and you're working with Goldman Sachs, for example, okay, you're trading partner. So what you do is, let's say you have a repo agreement with Goldman Sachs, right? So you say, okay, I have $100 million cash right now. So I can, do the repo with you. So sorry, I want you to do long repo. I don't want a short repo. Okay, so I do the reverse way. Okay, you have $100 million worth of a treasury bill. You have a treasury bill. Okay, very liquid, but it's not cash. It's a bill. But you want to do the repo. So you go to the Goldman Sachs, say, I want to do repo. So then you just selling this $100 million treasury bill to Goldman Sachs. Okay. Then you promise you will buy back tomorrow. Let's just say tomorrow or next week, right? So you buy back at a little higher price. So it's say 101 million. So that means Goldman Sachs overnight will make 1%. And you promise you're going to buy back. But the worst case, you do not buy back. But Goldman Sachs have your $100 million treasury bill. Treasury bill very liquid. You don't come back. I will sell it in the market. They will sell in the market right away and come back at $100 million. So they don't lose anything because that $100 billion treasury bill becoming collateral. Okay, so it means win-win for Goldman Sachs. Okay, for you also win because it's your security. You promise to buy back. Obviously, you know what you're going to do. So you put there $100 million treasury bill. You want a cash. So you need a cash. Why you need a cash? So you're willing to pay 1% to give a counterparty, and then you get the cash. Obviously, you have some deal can make more than 1%. So let's say you have some other deal, you can make a 2%. So lending out to Goldman Sachs, you buy back a 101, but then you have this 100 cash can make a 102. Okay, so that's how you make money, right? So that's basically both parties know what they're doing, and that's what they're doing. So money manager, hedge fund, for example, that's the whole point from hedge fund, okay? Hedge fund, they do exactly what I just said, do the repo with Goldman Sachs, with JP Morgan, with all the banks, right? They do the repo. So when the market booming, 2007, we will talk about financial crisis anyway, but I touch here, just mention it. 2007, that moment booming, okay, everybody needed cash, do more things. So what happened? They do this repo collateral, they don't have enough treasury bill anymore. All the treasury bill already do the repo. So what they do, so money manager gonna use mortgage-backed security, going to use ABS, asset-backed security, going to be use everything else to repo. Can you believe it? So then they said they promised buy back at a higher price, and they did in the beginning. But then once housing crisis, you know that when housing crisis, mortgage-backed security inside all the mortgage, right? So that's the problem. But housing, if it collapses, the security will lose the price. So then this buyback things, repo just suddenly stop, suddenly lose value. So remember, over the 40 years, you repo with Goldman Sachs. Suddenly, Goldman Sachs said, no, I'm not doing this with you. You're so risky. Okay. And then you need the money to turning around. You have so many things linked to this business, right? And then you're going to find out, let's say, you're going to find out the Citigroup say, I want to trading with your repo. I need this money, cash. And then Citigroup say, all those years you're trading with Goldman Sachs. Wall Street, they all know who's who. And you're trading what? And they all know partner because they do business partner, right? Business partner. And they say, wow, you're trading with Goldman Sachs many years. Why suddenly come back to me? Actually, they don't need to ask. They already know mortgage market already have trouble. Once we have delinquency 30 days delinquency. Already signal come out, the mortgage market have trouble. So then they don't even ask, they just say, no, I'm not going to do it with you. So nobody's going to do with, especially in that moment, looking for trading partner, nobody will be do with you. So that means you don't have money anymore, no cash. So therefore, no, everybody, not just you, a lot of people, same thing like you, have this cash crunch. Okay, that's repo, suddenly stop. Repo, just like blood of your circulation system, suddenly this repo market crashed. No banking get the cash. So that's why you heard about the cash crunch, credit crunches, all this because this is a crunch problem. So that's why the Fed wanted to organize this repo market. That's why you see this overnight repo definitely remove out just a couple of weeks ago. And they clean up this market because this is the whole point. Everybody borrow money to trading money. That's the, all the banking doing that. That's big. So that's why it is a bad example. So that's repo market, okay? But right now still have repo, but clean up a little bit because that's how funding, how they get the money. Business is trading that. You have actual assets, you want to do the repo, get the cash, so you can do something else. You wanted to make, you have new idea, new product, and many things, right? So money floating around. And that's what they did. Always have market creative, create new things because client wanted, and you do that. But for a while, the regulator never catch up. So they becoming crazy, Wild West like that way, okay? So that market, that moment, just like a Wild West, so my mortgage market crazy. So you will learn this, and always have a new idea, but always have bad apple playing those new ideas, always. Okay, you think a given store, that situation sort of squeeze a lot of things they're going to find out maybe, so we'll see. So that's the repo market, okay, to tell you a lot of link to the financial crisis, but more, I just quicker to mention this story because too long the story. Okay, so other things, right? So now we go to capital market. So like I said, capital market is long-term big, a lot of instrument, okay? Let's go there, I'll give you bigger because it's screen too small. Okay. First one, you can see that's the stock market, right? So in the capital market, you can see the stock market by then. Right now, I have to mention this. If you're curious, I curious yesterday, actually, I was just wondering how much our balance sheet print, how much money we print in the Fed balance sheet, right? So we 2008, we print like a 2.5 trillion and all the way to 4.5 trillion. And right now we are almost 7.5 trillion. We all the way up. So it's a lot. So that's trying to tell you also here, look at stock, right? So corporation stocks, 17 trillion at 10 years before. So right now it's a lot of more than that because only Microsoft, only JP Morgan, only Apple already trillion dollars corporation. Just corporation, each one name is just already a trillion. Now you tell me this market a trillion. So the 17 trillion definitely is not enough. All right, so that's what I tell you. Okay, so corporate stock. And then you can see mortgage, right? You have residential, that's you and me, okay? So that's the mortgage market. Remember, our money never sleep, right? So those, you pay mortgage, those mortgages securitized, means selling to, as a security selling to other investors. So that's what the mortgage-backed security, that's what it is. We'll mention it more, okay? So this is residential mortgage. So those size mortgage are gonna issue security already. So you can see 9 trillion. You see from 10 to, so 30-year difference, right? So you can see there's 9 times already increased. And corporate bond, corporate bond, corporation borrowing issued a security, and there is almost 3 trillion. Everything 220 will bigger number, definitely. I promised you, everything's bigger, no small one. So that's how money scary. Right now it's scary, it is, okay? So U.S. government security, of course, we are in deficit. So government security, we issue those treasury bond. We issue the bond means we borrow, right? And you can see that how big it is. But if you calculate ratio, 2.8 trillion divided by 407 billion, that's a big ratio, right? So government agency, This is just like, you know, you heard about the Fannie Mae, Freddie Mac, those are security. Actually, I should mention a little bit, okay? So this government agency security is not a government-owned security. It's not this mortgage government security, okay? Government says our government borrowing, I guarantee you, and you know, tax you to pay the bill. But this is not. It's a government agency, just like working for government, but it's not a government-owned. But because this mean here, that's why a lot of people are confusing. During the financial crisis, so many people thought it's government agency give you high yield, give you good deals. You also feel this is government only, government, so you link it to government, right? So you feel it's safe. All the global, a lot of, I even dealing with a couple of this kind of bankings, they're holding this kind of agency like a Fannie Mae, Freddie Mac. And then what happened? This is not a guarantee. So during the financial crisis, 2008, they first fell. Okay, so they failed. So they default basically. We pay out your money, my money. So taxpayer money come out, pay out them. So several billion dollars pay out them. And then they pay out AIC. So then they don't have money pay out anybody else anymore. So that's the becoming issue. So here you need to know it is still subject defaults, even though it's a government agency, but it's not a government owned. So this is owned, okay? It's not, so they cannot, they still have default risk, okay? So let's see how much. See, look, they increased over time, all right? So everything increasing. So that's another security, means bond is a bond, okay? So another one. That's agency, actually, one more thing. You know how that works? This agency is normally it's a mortgage securitized, just like MBS, mortgage-backed security. But it is government do this. Government create this way is securitize those mortgages, but those mortgages is normally the people do not qualify to buy a house, but government want to help them to buy a house, set up the special program to do that. And then government securitize this security, and that's what it is. So whole point is helping people low income to be able to buy the house. So they do that way, but then end up turning very badly. Okay, so that's another thing. So local, state and local, you know, this is municipal. Okay, so our New York, if we want to borrow money to build up the tunnel, and so that's New York State issue called muni, called municipal bond. Okay, it's a muni. Local, New York City, okay, needed to borrow money, they issued a bond, and they can, you know, set in this way. So you can see also increasing, okay? You know, from now going forward, everybody going to increase. Why? Because we all have, all the state and the local, they all need to borrow money to go to financing our trouble this whole year. And also going to be increased tax. I promise that. I don't like to hear, but they will increase tax because they know they don't have money. All the whole year we don't do anything. How come they have money? So that's another thing. So they're going to increase tax. They're also going to issue more bond, municipal bonds. Okay. So that's another thing. Bank commercial loans. Bank make loans, right? Like I said, you open restaurant, you need the money, so you go to banking, go to JP Morgan, you're going to borrow commercial loans. Okay, so that's a banking whole point through loan. We're going to talk about this. So loans, consumer loans, commercial loans, the business loan, right? So then consumer loans, your borrow loan for student loan, pay your student tuition and those things. So they all increased, nothing going down. And the commercial and farmer, that's for the farmer special, gave them a special loan because they do business. So just a couple of things give you this market about the product, okay? So internationalization, right? So if you talk about market, financial market, you cannot leave out global, right? International, like Asian market, like European market, it's all interconnected because we trading with them and the market linked to us. So that's why we needed to know international. So that's why the market become internationalization, means linked to each other. Even our Fed a couple of days ago, Jamie Powell even mentioned about saying he almost talk with the other central bank, European central bank, Japan central bank, China central bank. they caught on all the times because they needed to working together because global, it is interconnected. Okay, so that's why the market connect each other very, very close than before. All right. So, okay, if we talk international market, then we have a couple important things, right? So you say foreign bonds, euro bond, what do I mean? Okay. So based on the definition, easy, right? See foreign bonds. So I want you guys read one, to give me an example using, I even give you the company, let's say BMW, a German car, right? That car company issued a bonds, okay? Let's say this one. So read this one, give me an example. So foreign bonds, so sold in foreign country and denominated in that country's currency. That's the BMW issue bond selling in the US. So in what currency?
In dollars.
Very good. Yes, in our currency. Okay, now you know. If a Toyota company issue bond in New York, so they selling in dollar, they are what bond?
They're foreign bonds.
Very good. Foreign bond. You know, when you learn next one, you will confuse the first one. Okay, let's go to the second one. So now we know the BMW, Toyota, how they are becoming foreign bond. But what's euro bond? Okay, how do we define that? Okay, so here it is. So bond denominated in a currency other than that of the country in which it is sold. Okay, I want to do it back again, use BMW, okay? So if BMW selling their bond in US, so if it's euro bond, we call them, so they're selling in which currency?
Any currency other than US dollar.
Euro.
Okay, so if it's BMW.
Then any currency other than euro.
Okay. Then what? Hold on. I should use, I don't want to use euro, that kind of word, confused here, euro bond. I want to choose Japanese right now. Let's choose Japanese, okay? Japanese Toyota company issued a bond in the US. So they're selling which currency, then we call their euro bond.
It's a euro USD, so it's a euro bond in USD because it's not trading in yen, which is Japan's Toyota's native currency.
I'm use Toyota right now, okay? So the bond denominator in a currency other than that of the country in which it is sold. Let's use example. Toyota is Japanese car company. If they issued a bond in US, selling in US, if they are, we call euro bond, then they're selling in which currency?
In any currency that is not yen, right?
It's in any currency that's
let's
not
see people
dollar.
debate. Jessica, what do you want to say?
I was gonna say, like, they're gonna sell in US dollars.
In dollar.
Or not?
Okay, selling what? Just tell me the currency. The Toyota selling in the US, they selling which currency? So now we call euro bond.
Dollars, no? Oh,
Yen.
Oh.
But if a dollar, we go to foreign bond, right? If they're selling in dollar, we just said that. Selling, if Toyota is selling in the US in dollar, let's call foreign bond. Okay, so I'll give you right now, so we're done now. Okay, so it is in Japanese yen. Okay, and then you go back to figure out. That's why this word a little bit confusing you. But anyway, if Toyota is selling in the US, Toyota issued a bond, okay, Japanese bond, right? So selling in our currency or in Japanese currency, so that we call euro bond. But that's why I choose Japan, because it's not euro, it's not have to be euro. I'm gonna repeat this piece, okay? This is easy, confused one. So I will mention next time again, okay? So, okay, so have a good weekend. I'll talk to you next week.